Welcome to The Deep Dive, your shortcut to being truly well-informed. Today, we're plunging into the recent Q2 2025 earnings call for Oxbridge Re Holdings Ltd, ticker OXBR. Our mission here is, well, to cut through all the noise, pull out the most important insights, and give you a really clear understanding of what's actually happening with this company. Straight from the source, you might even find some surprising bits along the way.
That's exactly right. And look, this isn't just about crunching the numbers. It's really about understanding the story they're telling, the strategic shifts they're making, and the underlying currents shaping Oxbridge Re's future. What's genuinely interesting here is seeing how they're trying to balance their established traditional business with this really aggressive leap into something totally new, this Web3 powered frontier. We'll dig into the immediate financials management's, pretty bold vision and how the market reacted, which was quite cautiously, I'd say.
Okay, so let's unpack that. Let's get right to the headline financials for Oxbridge Re's second quarter of 2025. That wrapped up June 30th. And it was, putting it mildly, a really challenging quarter. The numbers definitely show that.
Yeah, challenging is one word for it. They reported a GAAP EPS of negative 25 cents. That's a huge miss compared to what analysts were expecting. They were looking for positive 3 cents. So it was $0.28 per share shortfall. And total revenue, that also fell pretty short. Came in at $0.664 million against estimates of about $1.127 million.
Right. But despite those pretty glaring top-line misses, net premiums earned actually went up a little bit, up 3.2% year over year to $0.582 million. But like you said, the real story, and it's a stark one, is in the ratios.
Absolutely. The loss ratio just soared to 394%. And the expense ratio hit 227%. Add those together, and you get a combined ratio of a staggering 621%.
Yeah.
Now, just for context, right, a healthy insurer wants that number under 100%. That means they're actually making money underwriting. So 621%. I mean, it's not just unprofitable. It's truly catastrophic for their traditional reinsurance side this quarter. And this was mostly driven by Hurricane Milton. Caused a full limit loss, $2.29 million on one specific reinsurance contract. That means they paid out the absolute maximum possible on that policy. And that single event hit their net equity by $1.18 million. Significant.
Wow. Okay, and how did the market take this news? You mentioned caution. There was that initial pop after hours.
Yeah, for a moment we saw maybe a 6-7% jump right after the release. Looked like some positive sentiment, but that fizzled out really fast. The stock closed down about 2.3% on August 14th, and then it kept drifting down slightly the next day, closing at $1.66, down from $1.69. So yeah, that muted reaction after that little blip, it really suggests investors are pretty wary overall, despite maybe some hope flickering briefly.
Okay, so with those tough numbers out there, what's really going on behind the scenes? What are management's priorities now? Their core business is still traditional reinsurance, right? Focusing on those low-frequency, high-severity risks, aiming for long-term book value growth with fully collateralized policies.
That's the traditional side, yeah. But the really fascinating part, as I mentioned, is this huge strategic pivot they started back in 2022. That's when they set up SurancePlus Inc. That's their subsidiary focused on real-world asset RWA Web3 technology.
Okay.
The whole idea is to seriously diversify the business. They want to democratize tokenized real-world assets. Specifically, they're offering tokenized reinsurance securities as alternative investment opportunities. And they keep emphasizing using blockchain for total transparency and SEC compliance. The goal is to open this up beyond just the super wealthy folks who normally get access to this kind of opaque asset class.
Okay, let's dive a bit deeper into the financials then. Beyond Hurricane Milton, you mentioned total expenses jumped massively to $3.61 million from about $628,000 year over year. That's enormous. What drove that specifically?
Yeah, that's a really critical point. It shows where the money's actually going right now. So part of it was the hurricane losses, definitely. But a big chunk was also increased HR costs. Professional marketing, IR specifically for that Web3 subsidiary, SurancePlus, plus some renewed estuary-related costs, and pretty hefty legal expenses too. So, I mean, what that tells you, connecting the dots, is that while the hurricane hurt, a lot of that spending increase is actually investment into SurancePlus and building out that Web3 ecosystem. It's an aggressive bet on a very new market.
Spending big to build it out. So what kind of returns are they actually pitching for these new tokenized products?
Well, management's highlighting their 2025-2026 tokenized offerings. They see this as a huge market, like a $700 billion reinsurance market overall. They're targeting two main products, a balanced yield one, aiming for roughly 20% annual return, and then a high yield product targeting around 42% annual return. Now, that's assuming no underlying losses, which is a big if. A key selling point they're pushing is that this sector is uncorrelated to the wider capital markets. Good for diversification, but, let's be clear. Those high yields, they come with risk. It's a new asset class. There's regulatory uncertainty. It's definitely not guaranteed, but it shows the kind of potential upside they're shooting for.
And partnerships seem key to this strategy too, right? They've been actively building a network.
Exactly. They already had that memorandum of understanding with Plume, which is a known RWA platform. Now they've entered a strategic partnership with Midnight Foundation. It's an input-output growth company, and it's linked to the founders of Cardano. So the idea here isn't just getting more reach for SurancePlus. It's about strengthening distribution. And, importantly, positioning themselves at the forefront of this whole blockchain-enabled RWA innovation space. These partnerships are like signals to the market that this Web3 thing has real collaborators and potential ways to actually scale up.
Makes sense. And for investors looking at any new high-yield thing, compliance and transparency are huge concerns. How are they tackling that?
Yeah, and they seem to know this is crucial. They're really trying to differentiate here. Management stressed how important compliance and transparency are. Maybe even more important than just attractive yields for RWA investors. They specifically pointed out that SurancePlus has segregated PCAOB audited financials. Now, PCAOB, that's the Public Company Accounting Oversight Board. That's basically the gold standard for public company audits. So, aiming for full transparency. They also really hammered home that their tokenized products are one-to-one collateralized. Every token is backed by an equivalent real-world asset. That's critical. It takes away the leverage risk, the fractional reserve stuff you see elsewhere in crypto. They're trying to build a much more secure investment, build real trust.
And they've been hitting the conference circuit hard, too. Miami, Denver, Cayman Islands, Dubai.
Yeah, incredibly active. iConnect, ETH Denver, Apex Invest, Token 2049, the list goes on. And look, this isn't just about getting their name out there. It's way more strategic than that. Well, this aggressive conference schedule, it's like a major push to quickly bring institutional money and partners into this very new Web3 reinsurance market. It signals management is really all in on this pivot, even with the core business struggling. And it shows that they're actively looking for outside validation and, well, probably future funding too. It suggests they're building a whole network, not just a product, which you absolutely need for any new financial ecosystem.
Okay, and looking forward, they've scheduled this extraordinary general meeting, an EGM, to approve things like a 2025 omnibus incentive plan. Management said it's about putting all the building blocks in place. What does that phrase really tell us about where they are now and, their readiness?
That phrase, putting all the building blocks in place, I think that's really telling. It strongly suggests they're gearing up for something big, maybe a major capital event, maybe a significant token launch. They want to accelerate the strategy, grab that leadership spot in RWA Web3 when the time is right. But crucially, it also kind of implies that the Web3 venture isn't quite ready yet to generate enough revenue on its own to offset things, which puts even more pressure back on that traditional struggling reinsurance arm to hold things together in the meantime. So yeah, it definitely highlights this is still very much a build-out phase for the new business.
Right. So you've got these challenging Q2 numbers, this really strong strategic pivot, and management talking mostly about the Web3 future. How does all this fit into the broader market context for Oxbridge Re?
Well, the overall feeling, as we said, is still pretty cautious. Those huge catastrophe losses from Hurricane Milton, they just completely overshadowed the small premium growth and all the positive noise around the RWA stuff. If you look at media coverage, it mostly focused on the major earnings miss, the widened loss. Less immediate focus on the long-term strategic play.
And that really showed up in the stock price, didn't it? Significant underperformance.
Oh, absolutely. Oxbridge Re has massively underperformed its sector ETF, KIE, that's the Property and Casualty Insureds Index, and it's way behind the broader S&P 500, the SQY benchmark, over the past year. OXBR was down something like 33.1% over the last year. Meanwhile, KE was actually up about 7.8%, and the S&P 500 gained around 16.2%. Big difference.
That really drives home the point, yeah.
It does. It highlights this key tension. Management is pushing the long-term potential of tokenized reinsurance, the partnerships. But investors right now seem way more focused on the immediate hit from the hurricane losses and, the risks around funding or potential dilution down the line. It's like the market is basically saying, look, fix the core business profitability first, then we'll get excited about your Web3 dreams.
And just to be clear, management didn't give any formal forward guidance on revenue or EPS for the traditional side.
No, they didn't. Their comments were almost entirely focused on the product roadmap and partnerships for SurancePlus.
Okay. And industry-wise, Hurricane Milton was a big event. What does that mean for reinsurance pricing?
Yeah, Milton was noted as one of the costliest. Now, reinsurance pricing for 2025 is seeing a bit of a tailwind. Rates are generally higher, which should be good for insurers. But the near-term loss development, how those claims actually play out, is still pretty unclear, opaque. So what this suggests is, yes, maybe we're in an era of more frequent or severe catastrophes, which could keep reinsurance prices firm. But that also massively increases volatility, especially for smaller companies with smaller balance sheets like Oxbridge Re. And that dynamic just makes diversifying into something like fee-based RWA income even more crucial for their story over the next few years.
Right.
It offers a potential path to revenue that's, hopefully more stable and less volatile. All right, let's shift gears. This is the segment where we throw out a trade idea. Might seem a bit out there, but maybe just plausible enough to be interesting. And remember, everyone, this is purely for entertainment, for provoking thought. Definitely not financial advice. Absolutely. So you've heard the story. 621% combined ratio, huge stock underperformance. But also this really bold move into tokenized reinsurance, talking about yields up to 42%. It's a company at a very, very clear and a very volatile inflection point.
So here's the idea. Given how badly OXBR has underperformed this past year and management's super aggressive pivot into RWA Web3, our outrageous but maybe plausible trade idea is a leveraged long position on OXBR. You probably look at an out-of-the-money call option maybe expiring sometime in early 2026.
Right. And the thinking behind that, the rationale, is basically this. The market right now seems totally fixated on the awful quarter they just had, the catastrophe losses. It's pricing the stock like it's just a struggling, pure-play, traditional reinsurer. But management keeps saying they're putting all the building blocks in place for what could be a totally transformative future with SurancePlus. So if those EGM approvals happen smoothly, if one of these new partnerships, like Midnight Foundation, actually leads to significant capital coming in or big token sales, or if the market just starts to genuinely price in the potential of those 20% to 42% annual returns from the tokenized products, then this small, nimble company could potentially see a massive re-rating.
So you're basically betting that the Web3 diversification story completely takes over and overshadows the volatility in the traditional business. It's definitely aggressive. You're buying into that 621% combined ratio number hanging over them, but you're banking on that huge total addressable market for reinsurance they keep talking about, combined with their focus on compliance, the one-to-one collateralization. You'd be playing for a complete narrative shift, from just a struggling small-cap insurer to maybe a pioneering Web3 financial innovator. It's high risk, high reward, absolutely. And it really hinges entirely on whether that strategic pivot actually works out. So there you have it. Oxbridge Re Holdings Ltd, they're navigating a really pivotal time, trying to balance the immediate financial pain from major catastrophe losses with this ambitious long-term bet on tokenized reinsurance.
Yeah, the hurricane impact was severe, no question. It definitely overshadowed the small premium growth and the momentum they're trying to build with SurancePlus. And while management is clearly committed to diversifying, and they're emphasizing transparency and compliance, which is good, the market's cautious reaction really underlines that investors are watching that core reinsurance business profitability very closely, and they're watching the company's ability to handle future catastrophe risks.
So the success of that whole tokenization strategy and what happens at that upcoming EGM, those are going to be absolutely crucial. They'll really shape investor confidence and the company's path forward. This has been our deep dive into Oxbridge Re's Q2 2025 earnings.
And maybe that leaves us with a provocative thought for you, the listener. What does this Oxbridge Re situation tell us about the broader market's appetite, its willingness to actually value these future-facing, potentially disruptive ventures, especially when they're packaged together with established but volatile traditional businesses? How will the market ultimately weigh the tangible, immediate pain of a big catastrophe loss against the, intangible, long-term promise of a Web3 transformation? Something to think about.
Definitely something to think about. As always, thank you for joining us on the deep dive. We encourage you to keep exploring the ideas we've talked about today.